Good afternoon, everyone. Welcome to 3 common misconceptions about investing. As I said earlier, we're going to be informed and instructed by Mr. Neil from Sterling Asset Management. And this is a session that ought to make you wiser regarding investing matters by the time you all leave here. Mr. Neil has significant experience in the financial field, and I will not dawdle any further. Mr. Neil, I hand over to you.
Thank you for having me here today, and thank you to the members of the CCRP for allowing me and my team from Sterling to present to you today. My name is Dwayne Neal, Assistant Vice President, Personal Financial Planning at Sterling Asset Management. And I really just wanted to speak with you today on some of the misconceptions that we've heard. We speak to a lot of people on a daily basis, and it these are both persons who are in their pre-retirement years and persons who have already gotten to retirement. And we've decided to look at some of the misconceptions that we're hearing and to give our perspective on these views and to give you options to mitigate against some of these. Today we're going to be looking at retirement from two perspectives: pre-retirement and post-retirement. Reason being, in your pre-retirement years, how you invest, how you put your money to work for you is going to be different from how it is when you get to retirement. Pre-retirement, your goal is to maximize your earning, create the largest possible pool of funds that you can have for when you get to retirement, you then have that pool of funds work for you. So I'm going to take you through 3 misconceptions that we are seeing. Okay, so the first misconception that we tend to hear a lot from investors, both pre-retired and persons who have retired, is that the bank is the safest place for your money. And when we speak about safety, we realize that we persons tend to look at it from 2 perspectives. One, the perspective of insurance, and 2, from the perspective of the value of your money. So let's look at the insurance perspective. So a lot of people think that having your money in the bank is really safe because it's insured. But what a lot of persons don't realize is that having money in a bank account, it's insured but only partially. So under the Jamaica Deposit Insurance Corporation, your funds are insured, but it's up to $1.2 million per person per institution. So having more than $1.2 million sitting in a bank account, or even in multiple bank accounts in one bank, can be detrimental should something happen. And 2, having it, you would really need to spread your money across multiple institutions to ensure that you have below that $1.2 million in each institution for you to be fully covered. We've seen in the news recently, over the last few years, we've seen lots of instances where financial institutions have had issues with fraud and theft. Those have not only been concentrated in investment companies, but also banking institutions. So it is important to understand that, 1, your funds are insured, but to a limited extent. On the investment side, so with Sterling, for example, if you were to invest your funds rather than have them in a bank account, if you were to invest with us, the securities that we invest in for our clients, they are insured through our US brokers. So there is more safety if it is that you're looking for a more holistic insurance coverage of your investments, which would make it safer than having it in a bank. From the value perspective, however, we've seen where people think that, okay, just keeping that money in the bank account, because you put $100 in, you're gonna have $100, and you may make a little bit of interest on top of it that makes it safe. But safety from a value perspective can be eroded in two ways. And it's important that we understand both to know how it is that we need to go about investing our funds to ensure that we outpace, any erosion of the value. So the first thing that we look at when we look at the value of your investment is a lot of us, especially, well, persons in Jamaica who would have earned Jamaican dollars, we tend to want to hold on to Jamaican dollars, invest in Jamaican dollars. But what we are ignoring is the fact that over time, the devaluation of the dollar is eating into your spending power. So if we so that devaluation, if you had, let's say you bought 1,000 US 15 years ago, left it in your bank account, when you go back today to convert it back to Jamaican so that that when you're ready to spend it, then you'd be getting more Jamaican dollars in hand. That's without even investing. So if you had kept that same Jamaican dollar value 10 years ago, right now you'll be able to buy less goods and services with that $100. So the devaluation is one factor. So we encourage our clients, our investors, our potential investors to look at investing in a hard currency, a currency that appreciates more than against other currencies, more than it depreciates. And for us, the US dollar is really an ideal currency to use to kind of to mitigate against the loss in devaluation. The second factor that eats into the value of your funds is inflation. We've all seen the effects of inflation. Inflation, simply put, is the increase in the price of goods and services over time. So what we could have bought with $100,000 in 2024, in 2026, those goods and services that we can buy are going to be reduced. So if you look on the graph here, you'll see 100,000 in 2024 at a rate of 3.4% inflation. The value of that 100,000 now falls to $93,000. So what this means is that as a consumer, if you don't find a way to earn on your money at a rate that's higher than inflation, you are now forced to consume less goods and services than you would have a few years ago. So what we encourage our clients to do is, one, when looking at the rate of inflation, you want to find investments that can outpace inflation. Reason being that will allow you to maintain, or at least maintain, your consumption. If you're able to find investments that outpace inflation, then you are able to grow the value of your investments over time. It's important to note that when looking at investment options, there are an incremental increase in interest rates can be very beneficial to you, especially in the long run. But let's start with a look at the short term. If you had $100,000 sitting in a bank account, you put it down for a year at 1%. When at the end of the year, what you would be looking at is you would now have $101,000. Versus if you were to take that same money and invest it in an instrument that's similar to a bank account. So in this case, we use the example of a repurchase agreement. A repo at 1 year at 5%, it exhibits a lot of the qualities of a bank account.
So it looks like you're not going to go in there.
Higher interest rate.
Okay, so then what you do instead for me is somebody was coming to stay here. So did
somebody have a question? Oh, okay, sorry. You're right. So that if you took that same 100,000 and you had placed it on a repurchase agreement at 5% for 1 year, you would have been earning 400% more in interest. Rather than coming out with 101,000, you'd be coming out with 105,000. The beauty with a repurchase agreement, or I should say the similarity to the bank account, is that it's very liquid. If you do need funds before the maturity date, you can request funds and you do not have any price volatility. So you put $100,000 in for 5% for 1 year. At the end of the 1 year, you get your 100,000 and you get your 5%. So this is an avenue that you can look at if you are looking to earn more, but you still need the flexibility and the liquidity of a savings or a bank account type product. Also, when looking at interest rates, so a while ago we used the example of 100,000 at 5% for the 1 year. But just to give you a little more insight into this, over the long run, even an additional 1% or an incremental increase in your interest rate over time, over the long run, can be much more beneficial to you as an investor. So, for example, if you invested $10,000 at 1% and you left it for 20 years, at the end of 20 years, that 10,000 would be now valued at 12,201. If you had put that same $10,000 in an investment at a slightly higher rate, just 1% higher at 2%, that value would have now jumped to 14,800. And likewise, if you had gotten those funds invested at 3% over the 20 years, that 10,000 would now be valued over $18,000. So you'll see that just a 1% increase in interest rate over a 20-year period can have a much greater effect on your final sum of funds, which is what we are looking to do. You want to maximize your earnings while you're in your working years so that when you get to retirement, you have the biggest pool of funds possible. So while we're on the topic of investing in your pre-retirement years, so pre-retirement, what we find is that a lot of persons, you're looking for capital gains. You're looking to maximize, like I said, that pool of funds. And there are several instruments that can allow you to do it. An example of which is Sterling offers a mutual fund, US dollar mutual fund, which is fixed income based. So it's not, you don't see the volatility as you would with, say, an equity based fund. Here we have the graph of the fund since inception in 2003. If $10,000 was invested in 2003, you made no additions to your portfolio, you did no withdrawals, that $10,000 as at December 2024 would have now valued $86,000. So you can see the effect of having such an investment, leaving it for the long term and allowing it to grow. So we'll touch a little bit more on the mutual fund as one of the products that we have. But like I said, this is the type of product that you want to look for pre-retirement because this allows you to maximize the rate of growth of your investment. The second misconception that we've heard is that having a pension fund or investing in a pension scheme is enough for retirement. But what we have noted from our research is that there are limitations, especially in Jamaica. Given regulations by the FSC and the BOJ, the fund managers are limited in how they can invest your funds to maximize your return. So, for example, pension funds are limited to how much they can invest in US dollars. Majority of your pension funds have to therefore be invested in Jamaican dollars. And between 1982 and 2019, if you were investing in a pension fund and they are only able to invest 20% in US dollars, then 80% of your investments are locked in Jamaican dollars. And when devaluation is applied to that portion, what we found is that you lost value at a rate of 12.4% per annum. If they were able to invest more of your portfolio in US dollars, then you'd be less exposed to devaluation, and therefore at the end of the day, you would have a larger sum of funds when you are ready to retire. Also, with pension funds in Jamaica, they are limited to how much they can invest in stocks or in equities. And we've all seen the stock market, how it's performed over the last several years. And we have seen that there is a potential for higher rates of growth when it comes to stocks or equities versus other assets. Local pension fund who can only invest, say, let's say they invest 24% in stocks, they will tend to have a lower rate of return than a US pension fund who may be able to invest 50% in equities. So these limitations will restrict what the final amount or that final sum of money is, or how much the pension funds can earn for you on your investments. Okay, and the third misconception, and this one is maybe the most topical, the one I tend to hear the most about, get the most questions on, is that you can't lose with real estate. And my disclaimer is this. I'll tell you upfront, I'm not saying that you should not invest in real estate, but it has a place in your portfolio, and you should also look at all the various aspects of it when deciding if real estate is good for you. So in looking at real estate, in hearing what people are saying, that the only way to generate and maintain wealth is through real estate, we decided who would be the best person to manage real estate. Whoever that person is, it would mean that whatever they can generate in real estate would be, let's say, our maximum return that we would expect to see on real estate. As an individual investor, you may not achieve as much as a company whose main or only objective really is to buy, sell, and manage real estate. So we looked at real estate trusts in Jamaica to see what sort of returns they were earning, to have a baseline or have an idea of what to expect if an individual decided to invest in real estate. So we looked at three real estate investment trusts, and what we're seeing here is that the returns range between 4 and 7%. So ideally, as an individual, if I'm invested in real estate, I'm anticipating that this would be my average return if this is where these investment companies who manage real estate day to day are earning. So the next line of thinking was, okay, what is comparable to real estate? What could give me, remember, real estate, we're investing in real estate for two reasons. One is capital appreciation, and two is for income. So we decided to look for other assets that could give you, which would have similar characteristics and could give you similar returns. What we found was that in the global bond market, you could find investment grade bonds with a 6-year or longer maturity that could earn you 9%. The reason we thought that bonds are a similar match to real estate is that, one, you can have price appreciation on the bonds, and two, the bonds pay you periodic income. So a lot of us will buy real estate to collect rental income each month to replace our income when we get to retirement, and that can be mimicked with a bond or a portfolio of bonds that will pay you periodic interest. Most of these bonds pay you interest quarterly, most pay semi-annually, some pay quarterly. But if you create a portfolio of bonds, it is possible to generate income monthly, depending on how many bonds are in your portfolio and how the interest payment dates on each. So realizing the similarities, we then decided to look at, okay, what are the what are the challenges that we would face on each? And when we looked at real estate, there are hidden costs that we tend to ignore when determining how viable a real estate investment is. Remember, when you purchase a property, you have maintenance costs and repair costs. You may have periods when, if you're buying it for income, you may have periods when your property is vacant. You may have delinquent tenants. So, you need to be behind them trying to collect your rent, to keep up with your obligations, because this was what you projected as your income on a month-to-month basis. And as you get older, decline in health, decline in mobility, it becomes more difficult for you to be trying to chase that person every month, in an effort to get your payments, and it that makes it a little more difficult as you get older, versus a bond where you're able to buy that bond upfront. You know your interest payment dates, you know when the money is due, when it's coming in. So it's a lot less challenging. And even when it comes to the rental income, rental rates do fluctuate. So the yields that you are earning will fluctuate time to time. But with a bond, you know what your rates are. You know if those rates are fixed, you know if there's any possibility of those rates becoming variable. All of that is shown to you at the beginning when you are making the investment. So it's a lot easier to plan for in that regard. On the capital gain side, so we we hear a lot of talk about the price of real estate appreciating across Jamaica and how well it has been doing. So we were searching to try and find some data, to prove or disprove how well it has been doing. And we came upon some data from the BOJ. They looked at average real estate prices between 2013 and 2018. And surprisingly, it shows that real estate across Jamaica only appreciated by 3.3%. Across Kingston, it was a little higher at 4.2%. So it wasn't at a rate that I would say that is unachievable with a much simpler investment, a much easier investment. So 3 to 4% could be achieved by investing in other asset classes without a lot of the risks that we mentioned earlier. But what we did learn, coming out of our research, was when there was a study done that showed that in 2019, the average apartment cost was $20.2 million. And that rose to $26 million in 2021. That was an appreciation of 28% over the period. When looking at the townhouse segment of the market, however, the average price in 2019 was 22.7 million, which appreciated to 34.6 million over the same period, 2019 to 2021, which was a 52% increase over time. So what this shows is that there is value in real estate, but if you do decide to go the route of real estate, also understand that different segments of the market perform differently. So looking at that, it will help to guide you if you do decide to go the route of real estate, versus other asset classes. So, like I mentioned earlier, a bond works a lot like real estate. You have less hassle, you can get higher returns, and it is much more liquid. When buying a property in Jamaica, we all know that the turnaround time is 90 days, 120 days, or even longer. When buying a bond can be bought in a day. So you skip that lengthy purchase process. You don't have to think about legal fees. You don't have to think about duties and taxes. Those all eat into your actual return when determining how much you can earn from real estate. Once an investor purchases a bond, they don't have to think about lease agreements, maintenance costs. They don't have to think about getting a property rented. When it's vacant, you're not earning. With the bond, your interest is fixed. You know when your interest will be paid, you know how much will be received, and it is much easier for you to plan based on that sort of income stream versus a property that becomes vacant, is empty for a few months. You need to spend on it to get it to the level that you need it to be for it to be rented again. So you may go for months without having any income from that property. And then when it is time to sell, you again go through that lengthy sales process. You have to think about paying that realtor out of what you are earning. So you do have a very long and cumbersome process when you're looking to buy or sell property. But with a bond, like I said, when you want to get in, you buy the bond. Within a day, that bond is in your portfolio. You begin earning. When you need to get out of the bond, it's pretty similar. The bond is sold, funds can be paid out in a day. Once that's paid out, you don't have to think about any other costs. You don't have to think about any commissions to be paid. So it presents an opportunity for you to earn similarly to you as you would with real estate if you are to invest in a bond. Here we have a few.
That's all I mean, park. That's all I park and stuff.
Oh.
Yeah, okay. Anyway, me just make a note. You can hear what you have.
Okay, so here we have some of the products offered by Sterling. We discussed each of them already. We discussed bonds, we discussed repurchase agreements or repos, and mutual funds. And I will put this slide back up for anybody who wants to get further information. And our contact details will be in the chat. If anybody wants to reach out to us, or if you would like us to reach out to you, please leave your email address, telephone number in the chat, and we'll also make contact with you. But like I said, these are some of the products offered by Sterling, and these are the members of our team. We are all online now, so if you want to speak to any of us directly, you can message us. So Tony Anita Elliott, she's the VP for Sales and Marketing. Anna Joy Tibby and Christine Rankin, both AVPs, Personal Financial Planning, and Tinane Thompson, Manager, Personal Financial Planning. If there are any questions, please feel free to ask.
All right. Thank you very much, Neil.
Thank you.
That was quite a mouthful. We have earmarked some time for questions. So CCRPers, if you have any questions, please show us your show of hands and let us hear.
I have a question.
There you go. Yes, go ahead.
I've had two bad experiences with bonds. You have mentioned the downsides. The latest one, and I really want to ask particularly about Digicel, which is creating waves as if they're profitable, but yet I have lost my investment in that bond.
Okay, so there are downsides or possible downsides to bonds, but like with any investments, my recommendation is that when looking to get into an investment, it's important to understand the details, understand the risks associated. So, for example, with bonds, there are rating agencies that rate different companies who issue bonds. And this gives you an idea of how risky or how high risk or how low risk an investment is. So, for example, if you looked at a Digicel bond, the rating by one of these agencies would have indicated that it's a high risk bond. For Sterling particularly, we focus on low risk investment grade bonds, one, because we understand that our clientele, our persons who come to us, they want to ensure the safety of their investment or of their funds. So we tend to be very cautious in that regard, and we keep our investments in bonds toward the investment grade side, and we do continuous research, continuous analysis of the bonds to ensure that if anything changes, we are able to guide you accordingly to allow you to either shift into a new investment or simply exit that investment before anything goes wrong.
Okay. There's a question in the chat, Brain, about minimum amounts for investing in the various options. I wonder if you might want to just comment on that.
Okay, so generally I'll say so all the figures that I've quoted or will quote are in US dollars, because sterling investments are all in US dollars. So the minimum investment amount is 10,000 US dollars, except for the mutual fund. So the mutual fund is a unitized fund. So your minimum investment really would be 500 units at the current market price. So right now that would be about 4,500 US dollars to get into the mutual fund. With a repo, for example, minimum 10,000. And on the bond side of it, you do have bonds with minimums of 10,000, some minimum 50, some 100, some 200,000. So those do vary.
Can I ask a question? This is Verla Seymour. Mutual funds.
Yes.
What are the risks attendant to it? I'm not very clear, because I know that if you put the funds are sort of pooled and mixed up, right?
Correct.
So one day you see a statement coming and it looks quite nice. And the next statement that you get, it falls, you know?
Yes.
So I need to get a little bit more on that.
Okay, so with the mutual funds, you are correct. It's really a pooled funds. So what we'll do is, so as different investors come into the fund, we have fund managers who will manage the assets of the fund. So you do have different types of funds. For our mutual fund, it is the backing securities really are global bonds. So unlike a fund that is backed by stocks, for example, you don't find a level of volatility as you would with a stock-based fund. So it is important to know when going into one of these funds what type of securities are invested in, and to also know the fund managers, know who is managing the fund, to understand and know that, you know, these are people who are looking out for your best interest.
Thank you.
You're welcome.
I see persons are asking if this session will be stored and carried elsewhere. Yes, the answer is yes. We did record it. Yes, we did record it, and as soon as it's posted to our YouTube channel, we will advise you, CCRP members.
And if for the presentation itself, if needed, we could send copies.
You could send that to me as well. Yes, and you
would
share that.
Yes.
Great. Good. Any other questions? Okay. All right. There's some kudos for you there, Dwayne.
Thank you.
All right. All right. So remember, if you want to be contacted by any of the persons from Sterling Asset Management, either share your email address with them in the chat or note their names and numbers so that you can give them a call. All right. We at CCRP, we encourage the sharing of information, and that you should actively seek as much as you can information relative to your situation, because in the final analysis, you will make your own decisions. All right. So are there any other questions for Dwayne and his team?
And while the neighbor claims she's just lighting incense,
No,
thanks in part to Clarissa's recordings. The
No.
case is
all right. So Dwayne, I guess, let me thank you. Let me thank Michelle Valentine, who was the go-to person for organizing this. And we thank you so, so much. Remember, CCRP, we have a few more minutes. So please note their numbers if you want to get in touch with them. There are the names. There's Dwayne, there's his number. Do take a note so you can make contact with them to get further and better particulars. So Dwayne, let me thank you.
And before you go, could I
yes,
just
yes.
probably you could spend a few minutes telling us about your organization. And I noticed that, for example, the VPs and AVPs are there, but no CEOs or how's the structure of Sterling Asset Management?
Absolutely. Over to you, Dwayne. Yes. Thank you, Miss Irene. Always on point. Thank you.
Okay, so our CEO, and it's Mr. Charles Ross. Charles has been in the investment world for many, many years. He was, prior to finance, Charles was an engineer. A lot of people that I've spoken to remember Charles from the Breakfast Club many years ago. So I get that a lot when people hear, oh, you're with Sterling. I remember Charles from the Breakfast Club. So we have both internal and external auditors. We have several independent board members who also guide the direction of how the company is managed and how we invest for the company and for our clients. So it's a very small team. Sterling, we have roughly 20 members of staff, but yes, I can send you further information on our directors and management team if you would like.
Yes, that's important. Yes.
Right.
Thanks.
Thank you, Ms. Irene. Any other questions? Any other questions? No. Neil, there's somebody there who wants you to get in touch with them.
Okay.
Anne-Marie Sharp, so you might want to note that.
Okay.
And we have your name and number. As I said to everybody, we are recording the session, and before long, we will have it posted to our YouTube channel, and we will write out to let you know when that is done. Dorrit, were you wanting to ask something?
No, sorry, no.
Oh, no worries, no worries. All right. Well, what a useful afternoon. You can't say you didn't know or you didn't hear. And if you heard but you want to know more, please call these persons at Sterling Asset Management, and I'm pretty sure they will guide you and straighten you out. All right. Thank you so much.
Thank you. Thank you for having us.
Have a good afternoon, everyone.